One recession indicator to rule them all. That's what I want to talk about. Hopefully you movie buffs get the reference there. But this is very important in my mind for us as investors, for us as those looking to build wealth and be smart with our money, because it's very hard to know what's actually going on. If you're anything like me, you can get overwhelmed as you read the headlines, and headlines are saying all sorts of things. Somebody's agreeing, somebody's disagreeing, and you don't quite know what to think. But that's the beautiful thing and powerful thing about this indicator, is it's just telling you it is what it is. This is what is actually going on. And if people are doing what they're telling us as the public they're going to do, well, this indicator is going to behave in a certain way. And that's how you can, it's basically like a lie detector. It's okay. All right, federal government. All right, Federal Reserve. Are you actually doing what you say you're going to do to, fight inflation and do all this? Or what are you actually doing? And this indicator, like I said, is going to serve as that metaphorical lie detector test for us. And it's funny, as I was putting the final touches on this, another headline came out which perfectly illustrates why this is such an important indicator and why, based on how it depends, is really going to dictate how rough a recession we actually go through. So let's first start off with a little bit of context, because we have been told by the Federal Reserve that two things are going to happen. The first thing revolves around the federal funds effective rate, which is basically interest rates. So if you follow the headlines, you'll see, the Fed is getting together to discuss interest rates, and this is what they're talking about. And what they've told us is, and what they've already begun to do, is start to raise these back up. So the interest rates, the Fed funds rate, is going to start to go back up per what is being told to us. So this chart is going to start going up. The other thing that has been told to us is as far as the balance sheet. Quantitative tightening, reducing the balance sheet, shrinking the balance sheet, all those are one and the same. And in that regard, this chart is going to start, or going to at least need to start, to go down. So if you want, you can track both those charts on your own and see if the Fed fund rates goes up and then the balance sheet goes down. But my point here is that that's not really needed, because the core indicator, and why I say it rules them all, is it's going to tell us what goes on in these dynamics here. So that's what we need to keep in mind, are these two things are going to be going on, and you need to keep an eye on them generally, but more specifically, just do this. Just watch the US 10-year Treasury. And the reason why this is so important is because this determines what's going on with the debt, especially when it comes to, for example, mortgages. That's probably the most famous. The 10-year Treasury has a large influence on whatever those mortgage rates are out there in the current environment. So no matter when you're watching this video, whatever mortgage rates are, if they're really high, the 10-year Treasury is going to be high. If they're really low, well, the 10-year Treasury, I'm guessing, is going to be pretty low too. And if these two things do happen, well, then this chart is going to go up. These yields are going to continue to rise. And once again, keep in the back of your mind right now that this is all associated with debt. So if you don't have debt, if you don't have anything like that, then this really doesn't matter to you. In fact, it helps you, because as rates rise, well, that means that your bank's going to start to pay you more interest for savings, right? Right now, savings rates that you would get in your bank account are basically nothing. That's because all these yields are so far down. But if they start to rise, you're going to get more. So this is only for focusing on debt, because that's where it ultimately matters. And as a side note, if you're interested, you can just, not interested, hopefully you do start to track this, but you can find some charts out there by just running a Google search right there for a 10-year US Treasury. Now, this is very, very intriguing, because as I put this together and going back to the whole debt conversation, you can see right here that mortgage demand falls to the lowest level in 22 years. 22 years amid rising rates. Again, rising rates is mortgage rates, yes, but that's attached to that 10-year Treasury, which has already been starting to go up, and slowing home sales. So right there, we have mortgage demand starting to drop. And why would that start to drop? Well, again, because it's tied to debt. As those debt payments go up, not as many people can afford houses, so why even bother with the mortgage? And you can start to see how that rising 10-year Treasury has already started to bleed over into the mortgage market, and it's already starting to affect things. But here's the crazy part, is things are going to get worse, but how high is the Treasury going to rise? That's the key question. And this all comes from an article that was out there, and just citing the article, but the quotes from it, and this is where, again, we're talking about debt. That's why all this matters. And I promise there will be a payoff here. But As this person says, neither the federal government nor businesses can afford 10% treasury yields. So in other words, this person is saying, if that treasury gets up to 10%, the government just can't afford it. It cannot afford it. Now, here's the crazy part, is that these were common in the 1970s. So it's not like because it gets up to 10% that, oh, wow, we've never been here before. There's no historical data. This is uncharted territory. No, that's the exact opposite. It was common in the 1970s. But but why is it such a different, or why is it's such a big deal now when you think about that it was common back in the 1970s? Well, get ready. This stat, I don't know what this stat's going to do. It's either going to maybe make you angry, shock you. Maybe you're not going to think it's real. I think I suffered from all those, but yeah, check this out. U.S. government public debt to gross domestic product is 125% now versus 31% in 1979. And I did the math on that, and that is a 303% increase, which has me feeling like that. What in the world? A 300% increase. That is bonkers, and that is the problem, and why these treasuries need to be watched very, very closely, because the higher those go, the more and more expensive debt is getting, including for the US government, which, as you saw, sorta, kinda, a little bit has quite a bit of debt right now relative to its GDP. And if it's going to keep fighting like it says it's going to fight this inflation, well, then it's going to raise those treasury yields. And the higher those treasury yields go, the rougher and rougher things you're going to get. Now, I don't know if I agree with the 10% number. I don't think it's going to even take 10% before things get really, really rough. But the whole point here being is that those treasury yields, that 10-year is going to rise. But it's just a question of how fast, how high is it going to rise? And then what happens from there? Well, there's a lot of different choices, and I can do a follow-up video on the next couple of choices that could be needed if it does rise too fast, too high. But that's kind of a side topic as far as this video, because this video, I just wanted to make you aware of and get your eyes on that 10-year treasury, because that's what's going to tell us the truth. If everybody does what they say they're going to do, that's going to rise. And if it doesn't rise, then you got to start to sit here and say, I think we're being lied to. I don't think people are doing what they said they're going to do, because, and the other thing is, if that doesn't rise, then inflation isn't going anywhere. That has to rise in order to fix inflation. So if that stays low, then inflation is either staying high or it's even higher than what it is right now. But if they do what they say they're going to do, that's going to be the lie detector indicator, and why I said, the indicator to rule them all. So start tracking that 10-year treasury. Let's see what happens with it, and let's see how things start to play out. But kind of crazy to think that it's only hit 3% so far, and yet mortgages are now at 22-year lows. I mean, what happened if the 10-year gets to 4%, 5%? Buckle up. I think things are about to get pretty rough. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.